Hello everyone and welcome back to my channel. My name is Kevin Holcomb, and for the last 9 years I've worked in the mortgage industry and I've seen a lot of things and learned a few things, and I'd like to share some of that with you. Today we're going to talk about getting prepared for the upcoming buying seasons that will come in the next hopefully year, 2 year, 3 years, depending on what's going on with the market. But getting prepared. Now, we've already talked about income in my previous video and what you should be looking for. Today we're going to talk about credit. So for today, without any further ado, as a loan officer, when I am talking to somebody and I want to get them pre-approved and I'm working on everything, running their credit and seeing what is on there, what their credit scores are, all of those things are just part of the puzzle of putting together somebody's pre-approval. So when we look at a credit report, and a loan officer has to run your credit in order to give you any real meaningful information when it comes to your ability to buy a home. They can't just kind of guess it, because there's too much stuff that can pop up on a credit report that can just slam the brakes on your ability to buy a house. So one of those things that we're looking for beyond just your credit scores is you're actually going to get 3 credit scores. So you've got Experian, TransUnion, and Equifax are the 3 main credit bureaus that are actually reporting information, and they're going to give you 3 different scores. Very rarely will they ever give you the same score, and not all 3. I've never seen all 3 give the same score. And it's because they all use their own formulas to come up with that score. And what we look as a loan officer and underwriting and so on past that point is, what is the middle score? So you can take your high, your low, and your middle, and that middle score is your qualifying credit score. So when you look at your credit, and how you do that is you actually go to Experian, TransUnion, and Equifax. You go to their websites and you can pull your credit report one time a year for free through their website. So it's actually very cool if it's something that you don't have access to. I mean, credit monitoring and things like you can get through your credit cards, that can give you an idea of what your score is, but it's not going to give you an idea of what's actually reporting on your credit report. So what's going to actually be on there. So you can go there and pull each one, and you can actually see what kind of what's going on and who's reporting what, because they don't all report the same stuff. It's very odd. I've seen accounts split up to where two bureaus report it as the same data, one bureau reports it as something else. Well, it'll be the same thing, but it'll still show as like a second line of credit when it really isn't. It's the same. I've seen collections pop up under one and not the other 2. All kinds of weird stuff that can go on there. So what we're looking for is looking at how many accounts you have, what type of accounts you have. So do you have installment debt? You know, usually like a car, auto, personal loans, things like that. Something that starts big and you just pay it off over time. It's not like a line of credit that you can keep pulling from. We're looking at if you had any past mortgages on there. You know, did you co-sign for somebody before you were looking to buy? Did you own a home in the past, and was it in good standing? Because that credit will still be there, even if it was years ago. We're going to look for collections. A lot of times collections aren't too big a deal, but it depends on what type of loan you're trying to do. If you're looking to buy a home and you've got like an FHA loan, if you've got more than $2,000 in collections, now we have to actually hit you with some of that debt. And it's generally going to be a percentage of what's actually showing as a collection. So that's something you kind of want to see. Do you have any collections? And we'll talk about what to do with them in a moment. We're looking at your credit utilization. So if you've got, you know, are you maxed out on your credit cards, or are you at like 50% utilization? Are you at 10% utilization? Those things kind of play into the credit score as a whole. So if I pull your credit and it says you're at 740, I already know that when I look through there, it's going to show that you've got low balances. That's just what happens. You have low balances and no late payments. That's what I'm going to see most likely when you're in the 700s. When you're in the 600s and in the 500s, it could be late payments. It could be you're over your limit on your cards. It could be a lot of things, but we're going to look at that. So what you can do as a consumer, as someone who is looking ahead and you want to start working on your credit, you want to start improving your credit scores, is you can look at, okay, how many credit cards do I have that are active? What are my balances, and what can I kind of chip away at here to get those balances down? So the credit bureaus are they rate how good you are with credit based on paying it on time and how much you utilize, how much you're actually paying each month, and what your actual balances end up being. So if you have a credit card that has a $1,000 limit and you're carrying a $500 balance, you're at 50% utilization, the credit bureau is going to give you a score based on that. Now, if you pay that down to $300, now you're at 30% utilization, the credit score is going to get better because it's saying, hey, you've got a low balance. It's going to show accounts that are inactive. It's going to show if you've ever been through bankruptcy. It'll show the bankruptcy on there, if you've ever had a judgment, and if it's satisfied or not. So if someone has actually had a legal proceeding and put a judgment against you, and it shows that it's not satisfied, meaning it hasn't been paid or taken care of, that's a hard stop. You can't get home loan financing with an unsatisfied judgment, because what a lender's afraid of is if they were to get you into a house, is that person can try to go after the equity in the house or force some type of sale, some type of legal proceeding that might interrupt that mortgage's ability to be number one in line to get paid, okay? So that's a big red flag. Now, you'll have other accounts that might show up there that aren't even yours. You might be an authorized user. So you became an authorized user with a sibling, a parent, a friend, your significant other, whomever that is, and that account will show on your credit. So I'm going to be looking at those things, and the underwriter is going to look at those things. We're going to analyze them. Now, the things that you usually have to work on is paying down balances and keep your balances low. But if you have collections, especially active collections, so within the last 3-4 years or sooner, non-medical, we don't care about medical collections because I think it's because so many people have them, so we don't really care about them. So I wouldn't worry about them too much unless you were specifically trying to get your credit up. But when it comes to collections now, if you pay that collection, it's still going to be on your credit report, and it's still going to show that it was a collection, even if it shows a zero balance. So it might help your credit a little bit, but just paying it isn't really enough. If you really want to help your scores, when you contact whoever the collector is, whoever that collection agency is, you can say, look, I'll pay you a percentage of what I owe. And you got to negotiate with them. I'm going to pay you a percentage of what I owe, but I need you to give me a deletion letter giving permission for the credit bureaus to delete this account once it's paid in full. And usually you can do that. And when you do that and you get actually off your credit report, so it's not even showing as there anymore, that's when your credit scores can actually really take off from collections. Now, satisfying a judgment kind of removes a hard stop, but it doesn't really change your credit scores. It's just something that you'll have to take care of. It doesn't give you a huge benefit other than now you can proceed to the next step. But I don't want this video to go too long, but when it comes to your credit, pull your own credit through the credit bureaus one time a year for free. Look at what your scores are, and then look at your actual trade line history and look at your debts, your active debts and what you're doing with them. If you can, pay some stuff down. Usually that's going to help. Make sure you pay it on time. Lates are the biggest killer of credit scores. If you are 30 days late on any account, you're going to lose some points. And if you had high credit, it's going to drop a lot. If you had marginal credit, it's still going to drop, but not as much. It's kind of how it works. But anyway, if you got any value from this video, please like, subscribe, share it with others. Comment down below about any tips or tricks, things that you've picked up when it comes to improving your credit, or kind of maybe ways that you've gone about analyzing it yourself or having it analyzed that might be helpful to other people. So that's what this channel is all about. I'm trying to help educate, trying to help get this information out there. Right now, the market, as you may know, is not great. Interest rates are high. We have a lot of inflation, so the dollar's not going as far as it was even a year or two ago. But we will see the market. It will come back, and if you get prepared now, you can actually take advantage of it. So that's it for me. I'll catch you in the next video. Peace.